Good morning, and thank you for joining the ADI Chemical Market Resources webinar this morning today. Thank you for making your time available for this webinar. My name is Uday Turaga, and I lead ADI and the ADI Chemical Market Resources team. Our goal here today is to talk a little bit about what's happening in the chemical industry and the outlook for the chemical industry, both in the near and medium terms. Just a couple of items around housekeeping today. We welcome your questions. Please send them using the questions and the chat window. We'll have a Q&A session at the end of the webinar, and we'll address all the questions that come in through the questions and chat window. We'll also share a copy of the presentation at the end with all attendees. We'll send the presentation via email. There'll be a one-question survey at the end of the webinar. We'll much appreciate if you could complete that one-question survey. Your feedback would be very valuable. And if you have any questions, comments, or thoughts, or want additional clarifications, please don't hesitate to reach out to us after the webinar. You can send us an email at info@adi-cmr.com. So let's get started here. We'll do a very quick intro to CMR, Chemical Market Resources, and then we'll get into the presentation today. Very briefly, ADI is a boutique consulting firm focusing on oil and gas, energy, and chemical markets. Within these markets, we work across the value chain. So if you take oil and gas markets, for example, we work in upstream, midstream, and downstream markets. If you take chemicals, we work across a broad range, including commodity and specialty chemicals. We also serve a wide range of clients within these markets. We help operating companies, but also companies that are selling equipment and services into the oil and gas, energy, and chemical markets. ADI is actually celebrating its 10th anniversary this year. ADI was started in 2009. In late 2017, about a year and a half back, we acquired the assets of Chemical Market Resources. CMR by itself has a longer history. They've been around since 1990. And have served over 200 clients through over 500 projects, all focused in chemicals, petrochemicals, plastics, and polymers. We at ADI saw an opportunity to extend our coverage across the hydrocarbon enterprise by acquiring CMR, which is why we acquired their assets in late 2017. And since then, we have invested in our capability to serve these chemical markets in a more comprehensive and aggressive fashion. So collectively, ADI and CMR cover the broad range of the chemical value chain, ranging from bulk and commodity chemicals all the way down to specialty chemicals. You'll see that we have worked in a number of chemical markets, as we have shown on this page. If there's interest in any of these segments, we're happy to share a little bit more info, including examples of projects that we have worked on. There's no dearth of consulting firms out there, and the way we differentiate ourselves in the market is primarily by bringing deep frontline industry expertise. So for example, CMR has the legacy of serving the chemical and polymer market since 1990. If you look at our team, you'll see a lot of deep industry and domain expertise, along with a rich set of core consulting skills. Collectively with ADI now, we bring a good, comprehensive, integrated view of the entire hydrocarbon value chain. So starting right from the wellhead down to the plastics that you see and interact with every day in your daily life. and we collectively bring a very extensive set of project experiences. With CMR since 1990 has served over 200 clients through 500 plus projects. So it's a very rich set of qualifications and credentials. You'll see some of the companies that we have served over this time here. You'll see that it's a broad range. We do a lot of work with the large operating companies in chemicals. We also support a number of the integrated oil and gas majors with strong chemical and petrochemical operations. CMR has historically had a very strong presence and insight into Asian chemical markets. And because of that, we've had the opportunity to serve a number of Asian chemical majors. But in addition to that, we serve a number of specialty chemical companies, as well as other stakeholders into the market. Private equity is a good example. ADI has served a number of private equity firms focused on chemicals, and with the acquisition of CMR, our work for private equity companies has further increased, and we're doing a lot of due diligence work supporting private equity transactions, as well as early stage venture capital firms focused on chemicals. We can help clients in multiple ways. In most cases, clients come to us for help and support in 6 areas. Usually it's around strategic planning. We'll help companies understand markets, identify opportunities, and develop competitive landscapes, and assess the external markets around regulatory as well as investment opportunities. We also help clients with sales and marketing strategies. Clients will usually come to us with help in understanding markets, to identify growth opportunities, to identify sales and marketing strategies, and go-to-market and channel strategies that help them grow these markets. We do a lot of work helping clients understand markets, and especially in cases where there's a lot of uncertainty, or when there's significant disruption happening in a particular segment. In addition to these market-focused issues, we'll help companies with functional issues. This would include things like financial and investment analysis focused around developing business cases for new capital projects, or build valuation models around M&A, as well as other transactions. And then also support functional capabilities around procurement and supply chain, as well as innovation, R&D, and new product development. I won't go through the list, but we have a full set of project experiences that is available. But over the last almost 30 years, CMR has supported over 200 clients through over 500 projects. Since late 2017, which is when ADI acquired the CMR assets, we have completed over 25 projects. Some of those projects are listed here. And you'll see that it's a pretty diverse list in terms of the kind of work that we have done. For example, right now we are working on 5 or 6 projects that cover oil field chemicals. We are helping a company that provides logistics into the chemical space. We're working on a study focused on the markets and outlook for cross-linked polyethylene. We are supporting an Asian chemical major with polyolefin elastomer markets, and also supporting a specialty chemical player with opportunities in polyolefin catalyst markets. So those are some examples of some of the projects that we are working on as we speak, but you'll see from the list that we have supported a wide range of clients in addition, and a wide range of topics in chemical markets. One of the things that CMR has been known for is a rich library and offering around multi-client reports that continues following the asset acquisition by ADI. If you go to our website, you'll see under the product section prospectuses for all the multi-client studies that are available. every year we continue to update a few of these studies and as well as bring out new multi-client reports. So if any of these are of interest to us, of interest to you, please take a look at the prospectuses on the website or reach out to us. If one of these studies hasn't been updated, we'd be happy to update it on a custom basis for you if that is of interest. Finally, long-standing CMR clients would recognize Flexpo, which is the annual conference that CMR organizes. We haven't had this conference in the last few years, just given the transition of CMR to ADI, but we are launching Flexpo back up again in 2020. It will be on April 14th. We request you to save the date, consider attending the conference, and of course we'll reach out with more details as we get closer. So with that, let us get into the details of the topic that we intend to cover today, focused on the outlook for the chemical industry. We are hoping to leave you with 4 key messages. We'll review these messages quickly and then talk about each of them in a little bit more detail. But basically, the way we see the chemical markets today, both globally and the US, they are underperforming and they're likely to stay challenged through the medium term, primarily due to falling demand growth. And this outlook for uncertain demand growth is the biggest driver around why US as well as global chemical markets are underperforming right now. Having said that, we do expect capital spending, at least in the US, to rise, driven by cheap and plentiful shale-based feedstock, primarily NGLs, that is available and continues to grow quite rapidly. We do expect some capacity additions in other parts of the world as well, and we'll talk about that a little bit later. In terms of capacity additions, the first wave of US ethane crackers are coming online. Most of them are online. A few of them should be coming online this year. And most of them have focused on investing in polyethylene derivative capacity investments. And most of it is LLDPE, but we are also seeing some LDPE production after a long time coming to the US, new LDPE production capacity coming to the US. Now, the challenge with these derivatives is that the market for all these derivatives is in Asia, in particular China, and given some of the challenges with the current tariff situation, that creates some risks for derivative investments going forward. Finally, there are opportunities for growth in chemicals, but those medium-term growth opportunities will come from niche areas. This includes chemical distribution and logistics, for example, is one area where we see a lot of growth. Sustainability around plastics and new technology that will address plastics recycle, reuse will play an important role. Some specialty polyolefin markets where CMR has historically had a lot of strength will continue to grow, and we see very interesting opportunities for growth there. And finally, there's a lot of innovation, of course, that's happening in the chemical industry that will drive some near-term growth as well. So let's talk about each of these as we go through the rest of the presentation. Now, before we get into the near-term and medium-term growth outlook, we want to quickly review commodity price, the outlook for commodity prices. In general, ADI, which publishes a monthly outlook for both oil and gas prices through its downstream market advisory, we've shared some of that outlook here. But essentially, we expect oil prices to be in the 60s or so, maybe marginally touch the 70s going forward in the near term over the next few quarters. There is uncertainty associated with the fact that there's a significant amount of supply that's available, There's also uncertainty associated with supply curtailments that we have seen because of sanctions on Iran, as well as some of the curtailments that we have seen in Canada and some of the reductions in heavy oil supply coming out of Venezuela. But in general, we believe that the fundamentals support a price in the 60s, and we expect to see that over the next few quarters. In comparison, natural gas prices continue to be challenged, driven primarily by a significant glut of supply. Natural gas, we believe, will continue to stay around $2.5 to $3 a million BTU over the next few quarters. In terms of chemical commodity prices, this is data from our friends at Polymer Update. You'll see that in general, over the last 12 months, ethylene and polyethylene prices have been stagnant or have declined in some markets. It's only in Europe where we see a little bit of uptick recently, primarily driven by product supply issues. But from a more fundamental point of view, ethylene and polyethylene prices have either been stagnant or have declined over the last 12 months. In comparison, I think propylene prices and polypropylene prices have been more stable, but within the US, of course, we have seen sharp declines. We have seen some uptick in the last month or so, primarily driven by maintenance and turnaround activity at a couple of the large propylene producers. But in general, European and Asian prices have been stagnant, while Gulf Coast prices have declined, primarily due to limited demand growth that we have seen in propylene and polypropylene markets. Again, this is data coming from our friends from Polymer Update. We just started a relationship with Polymer Update. They provide a wide range of commodity prices with a lot of historical data as well. We encourage you to visit their website for more information, or reach out to them or to us in case you need more information about commodity price offerings from Polymer Update. Looking at the chemical markets a little bit more broadly, what we are showing on this chart is MSCI global returns for all public companies, which is in the violet colored line, in the purple colored line here. And then we have publicly listed chemical companies globally in the orange line here, and you'll see that this year chemical companies have underperformed all public companies by almost 15%. And this underperformance has actually wiped out almost a decade-long performance premium that public chemical companies have enjoyed over other global public companies. So if you look at 10-year total shareholder returns for chemicals versus all public companies, you'll see that public chemical companies have overperformed or have performed at least a 10% premium relative to all global public companies. But a lot of that differential that we saw has declined significantly because of the underperformance that we have seen in the year to date in 2019. If you look at the US markets, we find that chemicals have significantly underperformed by more than 25% in comparison to the S&P 500 over the past decade. Now, of course, a lot of this underperformance has actually gotten magnified in the last year and a half. While prior to that, there was a lot of optimism for chemical industry, just given the availability of feedstock, and because of that sentiment, chemical industry markets were pretty much on par with the S&P 500. If you look at year-to-date performance, you'll see that chemical industry has underperformed by more than 35% relative to the S&P 500. If you peel the onion a little bit further and say, okay, how does that underperformance, or how does that performance get allocated between commodity and specialty chemicals, you'll find that commodity chemicals, which is this orange line here, have actually done better than specialty chemical companies in all of 2019. Of course, collectively, both of them have underperformed the S&P 500, as we know, but the difference is much starker when we compare specialty chemicals relative to S&P 500. If you look at the past decade, you'll see that there's not a big difference between specialty and commodity chemical companies. And you know, the traditional mental model that all of us in the chemical industry have is that we expect specialty chemical companies to deliver a better performance relative to commodity chemical companies, but actually the difference is fairly marginal. Specialty chemical companies are just marginally higher than in terms of total index growth relative to commodity chemical companies. So this is something interesting to keep in mind, because this reflects some fundamental challenges that specialty chemical companies face, and addressing these challenges is going to be critical for players in these markets. So we at CMR, because of our work in specialty polyolefin markets, tend to do a lot of work with specialty chemical companies around strategy, markets, operations, functional improvements, and across each of those areas, we see challenges that are becoming much more acute for specialty chemical players, and addressing them will take innovation, not just in terms of technology and process, but also in terms of business models for some of these companies to compete effectively. Of course, having said that, there are broader fundamental challenges associated with a lot of the drivers for the chemical industry, and the underlying reason behind this market underperformance for chemicals that we've just talked about is what's happening to the underlying drivers. So what we have on this chart here are some of the key market drivers. We have GDP growth, construction spending growth, auto sales, and broader industrial spending reflected through Purchasing Managers Index. And you'll see that almost 17 to 18 of these metrics across these regions are in the red, right? They are essentially decreasing year on year, and it's only a couple of it's only probably 8 or 10 metrics that are actually growing. And it's not just the broad numbers, but what's also interesting is that if you take auto sales, which has accounted for a significant share of polymer and plastic demand growth over the last decade, we are seeing dramatic declines in auto sales, not just in one or two regions, but across the world. So if you look at global auto sale data, it's down by almost 7% year on year. In some markets like China and India, for example, and even Latin America, the declines are in the double digits. So China's, for example, seen auto sales decline by over 15%, over 16%. India is a little over 12%. Brazil's almost as much as China at a little over 15%. So it's these underlying end-use markets that are seeing declines, which is translating into declines for the chemical industry. And then, of course, if you look specifically at the US and you look at the forecast and you compare that to what we have seen historically across the various chemical end-use markets, you'll see that there have been significant, that the outlook is actually quite bleak. If you look at all the end-use segments and you count the number of segments that are in red, they far outnumber the ones that are in green. A couple of the segments, the change is fairly small relative to what we have seen historically, but that essentially implies some sort of stagnation as opposed to growth in each of these end-use market segments. So it's because of these underlying factors that we see the underperformance in the global and as well as the US chemical markets in over the past year or so. So talking a little bit about capital spending, in spite of these factors, we expect capital spending in the US to rise, of course, driven by the availability of advantaged NGL feedstock. Now, having said that, we will expect some capacity additions in other parts of the world as well. But essentially going forward, we expect the capital spending in the US to rise a little shy of 5% every year, amounting to almost $42 billion in 2023. While this is fairly attractive capital spending growth. It's a little bit lower, obviously, than what we have seen over the past in the early part of this decade. But it's still good news in the sense that significant capital investments continue to be made in the chemical industry. If you look at where some of this capital spending is going to be allocated, a lot of that is going to come in US basic chemicals and synthetic materials, while specialty chemicals are going to see somewhat of a modest growth in capital spending going forward. Now, if you look at some of the basic chemicals and look at what's happening to their supply-demand scenarios, you'll see that ethylene and paraxylene are the two segments where we're going to see significant supply coming on stream over the next 5 years. And a lot of these supply additions are going to be far higher than what demand growth would necessitate. So essentially, we'll probably see some additional reductions in utilization rates for these market segments unless derivative markets pick up significantly. In comparison, propylene and benzene will continue at a more steady clip, and we don't see big changes in utilization. In fact, for propylene, we anticipate demand growth to be slightly higher than the projected rate of supply additions going forward. If you look more broadly and you look at, for example, urea and methanol demand and capacity additions, we see a picture quite similar to what we see for propylene, for example, where demand growth is going to be fairly robust in comparison to supply additions, and we would expect some challenges in potentially meeting some of this demand growth because supply additions aren't quite keeping pace. If you look at a lot of these capacity additions and the underlying decisions, obviously a lot of them is driven by feedstock economics, and in the US, the availability of ethane and the fact that it's incredibly cheap relative to naphtha provides that huge differential that justifies a number of these capital investments. And some of those fundamental economic competitiveness drivers won't change going forward. If you look at levelized cost of petrochemical production globally, you'll see that US and of course the Middle East continue to be very advantaged. Europe, surprisingly, is becoming advantaged primarily because they are importing a lot of ethane coming out of the US. But in comparison, the next big tranche of petrochemical producers on the supply curve tend to have much higher cost structures, and this will weigh in to some of the capital investment decisions that we will see in other parts of the world. So thinking about where capacity addition is likely to happen going forward, and we look at the big segments that have traditionally invested capital, what we see is that US crackers, some of the investment outlook is going to moderate, but this moderation is coming off of cycle highs. So essentially there's a lot of capital that has been invested over the last 5 years, and we expect some of that to slow going forward, but it's still a fairly robust estimate. In comparison to historical investment patterns, we see Chinese private companies as well as other Asian producers make much higher investments in chemical capacity going forward. And in comparison, state-owned Chinese companies as well as some of the Middle East producers are likely to moderate or reduce their capital investments relative to their historical investment patterns. Of course, some of this is related to the fact that in China, for example, there's greater governmental support now for private companies relative to state-owned enterprises making investments. So that's the reason why you see that shift away from state-owned companies towards private players. While in the Middle East, feedstock allocation issues continue to challenge the investments in chemicals for new capacity, and we expect some of those feedstock allocation issues to continue going forward. Talking a little bit in more detail around the US ethane crackers, we've seen a significant amount of ethylene cracking capacity come on stream. There's a couple more that should come on stream this year. But other than that, there's a second wave of ethane crackers that's been proposed, and there the likelihood of the second wave of ethane crackers moving forward will depend on a number of factors. So we just talked about this briefly, but a number of projects have been proposed. This includes new grassroots projects as well as some expansion projects as well. In addition to that, we have seen ethane export terminals as well that have come on stream, impacting the feedstock around petrochemicals. As I discussed earlier, we've seen a lot of ethylene cracker capacity come on stream. Some more capacity should come on stream this year based on the projects that are in construction. And if you want a little bit more detail around this, please reach out to us, because a lot of this was covered in a great amount of detail in the ADI Downstream Market Advisory. In the January edition of that research service, we went into a lot more detail around all the ethylene crackers and the outlook for that. There's a second wave of ethylene crackers that has been proposed. We expect this wave to be as much to be as big as the first wave in terms of capacity additions. But of course, there's only a small number of projects that are likely to go ahead, and that'll depend on a number of factors, right? It'll depend on what the ethane price outlook will look like. It'll depend on the availability of skilled labor, as well as the cost inflation associated with some of the capital projects. We've seen significant cost inflation on the US Gulf Coast around capital projects, driven primarily by tariffs on steel, as well as limited supply of skilled labor. And some of these factors are going to change the investment economics for the second wave of ethane crackers. In terms of derivatives, most of this ethylene that is coming on stream into the market is going for polyethylene production, over 75%, and about a little short of 25% is going into making other ethylene derivatives. But the number of projects have been announced, and they're likely to come on stream after 2020. Now, it's likely that some of them might not come to fruition, but in general, if you look at the developers behind a lot of these projects, we anticipate most of these projects to move forward. In terms of what kinds of polyethylene is being produced, most of it is LLDPE, but we have seen some new LDPE capacity as well, and it's for the first time that US is adding LDPE capacity in almost 2 decades, and some of that capacity investments and breakdown is provided on this page. Again, there's a lot more detail that's available as part of the Downstream Market Advisory. Now, of course, the challenge with a lot of the polyethylene that is produced out of North America is that a significant fraction will be consumed by North American demand, but there's almost a third that will depend on exports, and a lot of these exports are essentially going into China, Asia, other parts of Asia, Latin America, and some of the tariff outlook associated with some of these countries will have an impact on what happens to the ability to export these derivatives and how that will translate into new derivative investments going forward. As we talked about Chinese US exports to China, the tariffs that we have seen have significantly impacted exports. We saw fairly robust growth in the first 3 quarters of the year, but in the last quarter in 2018, we saw a significant decline in exports, primarily because of tariffs. It'll be interesting to see how that situation actually pans out this year in some, but we expect the tariff situation to have a pretty negative impact in general over the performance of the broader US chemical industry. Another key risk is around ethane supply and demand dynamics. Conceptually, there's a lot of ethane that's available in the US coming out of the shale plays. Today a significant volume of ethane is being exported or rejected. Once the second wave of crackers comes on stream, we should be able to absorb a lot of the incremental ethane production, and there's a significant chunk that will still be exported and rejected. The challenge, however, is what happens to ethane pricing as some of these new ethylene crackers come on stream. In general, the US has built a significant volume of ethane export capacity, and ethane exports have risen quite substantially over the last few years. A lot of this is going in to Latin American markets, and we expect some of these ethane exports to continue. But as ethane demand picks up, we expect ethane prices to go as well, because we'll have to start bringing in ethane from plays beyond the marginal suppliers, which are Appalachia and Permian, and you'll have to go and source ethane from plays as far as the Rockies, potentially having an impact on ethane pricing, which will eventually translate into impacts on investment economics for new ethylene crackers. Finally, we want to talk a little bit about growth opportunities in the near term in chemicals. We believe there are growth opportunities in chemicals, although the broader dynamics are getting increasingly difficult. We expect growth in chemical distribution and logistics, for example. Plastic sustainability and related issues would probably drive some new innovation and growth. Specialty polyolefins, we're doing a lot of work around how you can create growth opportunities there, and finally, new process technologies and innovation. So if you look at logistics and chemical distribution, for example, pretty much across the world, we are seeing the chemical distribution market grow at a much higher pace as compared to revenue growth or sales growth for specialty chemicals, and definitely more than GDP growth in each of these regions. What is interesting is that even in markets like Asia, which have traditionally been resistant to distribution as well as logistics markets, we are seeing greater maturity in these markets, and because of that, we are seeing rapid growth of distribution markets in some of the Asian economies. Collectively, we expect the market to grow at 5% annually. This is a little slower than what we have seen over the last 5 years, but still fairly robust growth relative to the growth of the overall chemical industry. In terms of new technology and innovation, we are seeing a lot of interest around crude to chemicals. The traditional process value chain has relied on taking crude oil, putting it through a refinery, generating feedstocks that will go into a steam cracker to make petrochemicals. There's a lot of R&D and innovation, especially happening outside North America, that is focused on taking crude directly and converting it into chemicals using multiple routes, either through the steam cracker using light crude, or for light and heavy crudes, we are looking at the use of crude oil conversion to paraxylene for petrochemicals or other technologies. Specialty polyolefins also continue to offer interesting growth opportunities. We just released the Tyler Resins multi-client report earlier this year, and we see robust growth there for Tyler resin markets. A lot of this growth is, however, centered in a couple of market segments. Flexible packaging, especially for food, is a big market segment for growth. So conceptually, as companies are looking for entering these segments or further growing their market share in these segments, while the market attractiveness, which we show on the chart on the right, on the y-axis, is fairly high for flexible food packaging, the issues are, there are quite a few issues and barriers to entry into these markets, and as a result, incumbents are more likely to succeed in growing in these market segments relative to new entrants that may be interested in looking at these markets. Of course, sustainability has been front and center within the chemical industry over the last few years. Pretty much all the major consumer brands have taken a position around sustainability, plastic use, packaging materials, and some of that is reflected here. Some of these companies are moving very aggressively. Nestle is a good example. They've recently developed in partnership with a couple of players a new recyclable paper wrap that they have successfully deployed on cereal bars that gives them the desired performance properties around sustainability issues. One of the interesting things is they are interested in sharing some of this technology more broadly across the consumer brand industry. So some of these initiatives can have pretty significant impact on the outlook for the chemical and polymer markets. Now, of course, this is also going to drive a significant amount of innovation. We are already seeing that. There are enough incentives in the market that a number of early stage companies have come and started investing in new technologies that will take post-consumer plastic waste and through a number of tools, whether it is conversion or decomposition or purification or mechanical segregation, bring them back into the value chain and create opportunities for reusing and recycling these materials. We are increasingly working with a lot of these early stage companies, helping them understand what the markets look like, what are some of the technology scale up and commercialization challenges. What we are seeing is that innovation just on the process and technology side is not sufficient. You need corresponding business model innovation in order for some of these technologies to be successful. But we are seeing some of these companies break through and find opportunities where some of their technology offerings and business model offerings are finding commercial traction and success. So with that, I will, that's all that we have in terms of the presentation today. Just to summarize, we expect global and US chemical markets to underperform in the medium term, of course, driven primarily by falling demand growth. Chemical capital spending in the US, however, will still continue to rise, driven by the availability of cheap and advantaged feedstock. Having said that, we expect some capacity additions to happen in other parts of the world as well. Number three, the US ethane crackers, most of them are coming online and most of them are producing polyethylene. But of course, a lot of that is being exported, creating some risks given situation with tariffs. And finally, we expect some growth opportunities in the medium term, but there'll be niche areas around chemical distribution, sustainability issues around plastics, new process technologies and innovation, and specialty polyolefins. So I'll pause there and happy to address any questions that might have come in. So we'll take a look at some of the questions that we have been getting around ethane prices, for example. What the outlook for ethane prices is. Fundamentally, our view around ethane prices is that we expect them to continue to be low and fairly advantaged relative to naphtha, and there should be enough differential that will incentivize their use, and as well as new capacity investment in the use of ethane to produce ethylene. So essentially, we expect ethane prices to be very competitive relative to naphtha, and we expect them to stay competitive for a long period of time. And we think so because of a couple of reasons. One is there's a significant amount of associated gas that is being produced out of Permian and Appalachia, and that includes NGLs as well. And we expect this NGL volume to continue to come on stream into the market. We also believe there's a lot of NGL supply that's available from other plays that can be brought into the Gulf Coast at relatively cost-effective prices. More importantly, there's a significant amount of ethane that continues to be rejected across shale plays in North America, and we expect that to have an influence. So collectively, I think through the near term as well as the medium term, we expect ethane prices to stay low and fairly competitive relative to naphtha, and sufficient to incentivize their use for ethylene production, as well as investments in new ethylene crackers. Now, of course, if all the second wave of ethylene crackers come on stream as projected or as planned, we don't anticipate that, but if that happens, that'll put enough of a stress on the market that we would expect ethane prices to rise a little bit more than where we are today. But even so, I think in general, we expect ethane prices to be fairly low and competitive going forward. We have a couple of questions around crude to chemicals, as well as the role of electric vehicles around the chemical industry. We tend to view both of those questions as being somewhat related. Let me start with the questions around electric vehicles. First and foremost, while we believe that electric vehicles will continue to gain traction, while we expect their costs and competitiveness to continue improving, there's still quite a bit of runway. We still expect their adoption to be uncertain. We expect regional differences in their adoption, and we expect the traditional internal combustion based engines and vehicles to continue to drive most of the market going forward. So while we don't quite share a lot of the market sentiment around and the media hype around electric vehicles, we do expect them to continue to improve their cost competitiveness, and it's definitely a factor that the industry needs to look at. Now, having said that, if you look at electric vehicles as such, and you look at their direct impact on polymer markets, for example, or chemical markets, we would actually see a greater use of polymers and chemicals in electric vehicles relative to traditional internal combustion based vehicles going forward. So I think on that basis, we don't see a big impact coming from electric vehicles on broader end use markets. But we do see associated impacts because of greater penetration of electric vehicles. As the penetration of electric vehicles rises, we would start seeing impact on fuel demand, because of which some of the smaller refineries or refineries that are on the higher end of the supply curve with higher marginal costs are likely to fall off the curve, and because of that, we would see some sort of a moderation in feedstock supply for the petrochemical industry. And that's the reason why we see some of the interest in crude to chemicals, where there's an opportunity to take crude oil and convert it directly into feedstock or directly into chemicals. That's the primary driver for some of the investments that we are seeing in crude to chemicals. We have a couple of questions around the role of digital transformation in chemicals. What are we seeing there, and how that is likely to impact the market? In general, most of the chemical companies have embarked on initiatives that focus on digital. Companies are piloting a number of projects around digital. some companies, of course, are further along the adoption curve and have embraced digital tools, technologies, and offerings in a much more holistic and comprehensive fashion. In general, what we find is that the chemical industry is further along relative to, let's say, the oil and gas, and that includes upstream as well as downstream refining segments. We find that the chemical industry is further along in evaluating and trying a lot of these digital technologies. Of course, a lot of the use of these digital tools and offerings has been around business model issues, around better connectivity with consumers, around automating and improving the efficiency of supply chains, or more broadly across functional organizations such as human resources, information technology. Their actual use in operational performance, reduce downtime, improve predictive maintenance. I think the level of adoption is probably similar to what we have seen in the oil and gas industry. And of course, some of that is associated with the fact that deploying some of these digital transformations to operations is a lot more challenging than it is to some of the other business units and functions. Now, having said that, we do think that digital is going to, digital adoption and penetration of digital tools and technologies is going to be higher in chemicals and faster relative to other parts of the hydrocarbon enterprise. There's a question around why base chemical investments and demand is growing faster than that of specialty chemicals. That's an area where we are doing a lot of research and trying to better understand the underlying dynamics. The reason why base and commodity chemicals are growing faster and are attracting more investment is fairly clear in places like North America, where there's a significant amount of advantage associated with the feedstock. Ethane is available cheaply, it's plentiful, and therefore that makes sense for investments around use of ethane to make ethylene and derivatives. But we are also seeing greater demand growth around commodity chemicals globally as well. And I think some of this is associated with the fact that over the last decade or so, base chemical capacity investments have lagged relative to the growth that we have seen in the market. And of course, some of that has changed in the last few years, but we expect that to be a primary reason as to why base chemicals have risen faster relative to specialty chemicals. There's another related question that we have on the outlook for specialty chemicals and specialty polyolefins in particular. So what we are seeing in specialty polyolefins is that there's a lot of demand growth. We are seeing a lot of innovation in specialty polyolefin markets. A lot of that is driven by the demand, by the capacity investments, for example, that have been made in polyethylene over the last few years here in the US. But what we are also seeing, a big trend that we are seeing in specialty polyolefin markets is a lot of intermaterial competition. Traditionally, there would be some segments where there would be a particular polyolefin that would have a dominant share, and we'd see very little change in market share for that particular polyolefin in a particular application or in a particular market segment. We are seeing a lot more dynamism and a lot more flux around the use of these specialty polyolefins in these end-use market segments. So in some market segments where over 90% of share would be allocated, would be for one particular polyolefin, we are seeing a lot more competition, a lot more willingness in end users to try other polymers and other polyolefins and other materials for their particular end users. And because of that, we are seeing a greater amount of intermaterial competition. Some of this is driven by hyper-specialization and hyper-differentiation that we are seeing around end-use applications and the desire for differentiated performance in end-use markets and end-use consumers and customers. But some of this is also driven by the fact that pricing for some of the new materials is changing and becoming much more competitive relative to incumbent materials, and that's driving some of the intermaterial competition that we are seeing in specialty chemicals. More broadly speaking, some of the trends that we see in specialty chemicals are around transactions, M&A activity, for example. We have seen a significant uptick in M&A activity around specialty chemicals. A lot of this is driven by the fact that growth has slowed in specialty chemicals. Several specialty chemical segments are getting increasingly commoditized, and the pace of innovation and the investments necessary to drive in innovation and investment in some of these specialty chemicals are becoming quite large as well as quite uncertain. And as a result, specialty chemical producers are trying to gain economies of scale and economies of scope by engaging in M&A and driving ways to reduce costs as well as gain scale and scope, and thereby compete more effectively in specialty chemical market segments. I think we have just a few more minutes left here. Maybe we'll take one last question, which we have a question here on what is the outlook for the ability to crack Y-grade NGLs within the US. So Y-grade NGLs are essentially NGL production coming off of the wells before they're fractionated, of the gas processing plants before they're fractionated. Historically, the U.S. chemical industry has relied on ethane coming off of the fractionators. So the fractionators would take Y-grade NGLs, separate them into ethane, propane, butane, and C5+, and the ethane would end up into the chemical crackers, into the ethane crackers. The ethane would end up in the ethane crackers to produce ethylene. We have heard that some of the large chemical companies and steam crackers are considering or have piloted the ability to crack Y-grade NGLs. Conceptually, we don't see why that is not feasible, but I think operationally the industry would have to do more work and trial and evaluate the ability to crack Y-grade NGLs in existing steam crackers for a while before it becomes much more before it is practiced more commonly. Of course, not all crackers are going to be able to process Y-grade NGLs, but we do expect some players, some of the companies, to be able to crack Y-grade NGLs and process them in their operations. So I think we're a couple of minutes away. We'll pause the Q&A session at this time here. The last thing we want to say is, if you like this presentation, please sign up for POND Plus, which is our monthly newsletter. We've just relaunched that again. You can sign up for the newsletter at our website, adi-cmr.com. It's a monthly newsletter. You can unsubscribe at any point of time, but it'll give you insights quite similar to what we have shared today. With that, we'll bring this to a close. Thank you for joining and participating. We appreciate your interest and support. Please don't hesitate to reach out to us if you have questions. We look forward to being of support. Thank you.